Hey everyone, welcome back to the channel. This is Financial Climbs, and today I'm going to be taking you through how to start investing in the stock market. Perfect for beginners and also helpful for a recap for those that are currently investing. So, first of all, what is the stock market? If you've ever wondered how people make money from investing or what the heck the stock market even is, you're in the right place. I'm going to start off with the basics. Now, the stock market is like a public marketplace, but instead of fruits or gadgets, you're buying and selling pieces of companies, also known as stocks. When you buy a share, you're buying a small ownership stake in a company. If the company grows and becomes more valuable, your shares also go up in value as well. It's where companies raise money and investors try to grow their wealth over time by spotting those gems. So, why do people invest in stocks? Well, why would anyone put their hard earned money into stocks instead of just saving it? Well, the first reason is growth. Over time, the stock market tends to grow, and historically, it's returned around 7 to 10% per year on average. It also provides something called dividends. Now, this is you receiving a portion of the company's profits back regularly, sometimes monthly, quarterly, or annually, depending on the company. The third reason is compounding. Now, the earlier you start investing in the stock market, the more time your money has to grow exponentially. Of course, it's not all sunshine and rainbows. Stocks can go up and down. That's why understanding risk and having a plan is key. Stick around and I'll show you how beginners can invest safely and smartly. The third part is about types of stocks and investment strategies. Now, not all stocks are created equal. Let's look at the different types. First, you have blue chip stocks. These are your big, stable companies like Apple. They're safer but slower to grow sometimes. Next, you have something called growth stocks. These are fast growing companies like Tesla, but with high reward comes high risk, and they often tend to be a little bit more volatile, as you may have seen yourself. The next one are dividend stocks. Now, these pay regular income, they're great for passive investors, and they tend to be a lot more stable too. So, how do people actually invest? Well, you can buy and hold, i.e., invest in something and forget. It's great for beginners, very hands off, uh, but it does mean you will require some patience a lot of the time. The second is trading. This is buying and selling stocks frequently. This is much more riskier and can be very time consuming, and I definitely avoid this if you are new to the stock market. The third is index investing. Now, this is instead of picking individual stocks, you buy a slice of the whole market. And an example of this is the S&P 500, which takes the top 500 performing companies and puts them together in what's called an ETF. If you're new and you want to start simply, index funds like these are a smart first step. How to actually start investing? Well, if you're ready to get started, here's how to go from zero to investing. You first want to pick a platform or a brokerage. You might have heard of Trading 212, there's Robinhood, Webull, Hargreaves Lansdown. There's plenty out there, and it's worth doing your research to pick the one that works best for you. Second, create an account. It's very simple these days through your phone, like opening a bank account. Um, Third, you'll need to deposit money. You can, of course, start small, even $50 or pounds is enough. Some brokerage firms even let you try it with fake money first. Fourthly, buy your first stock or ETF. Choose something safe like an index fund, like I suggested, if you're unsure. And remember, don't invest money you can't afford to lose, and always do your own research before investing. Now, before you go, I'm just going to give you mistakes you should avoid. The first one is often trying to time the market. You can't predict the highs and lows. It's always worth researching a stock rather than trying to find a specific time to enter. The next is avoiding FOMO investing. This is fear of missing out. Don't just buy a stock because something's trending. It's an easy way to get caught out. The third is not diversifying. Don't put all your eggs in one basket. You never know what could happen to a singular stock. One bit of news could tank the price. Of course, earnings every quarter as well are a catalyst for this too. So be sure to just spread and look at different stocks, and an ETF, for instance, is a good way of creating that diversity. So I hope this helps you understand how to start investing in stocks the smart way. If you like the video, give it a thumbs up and let me know in the comments what stock or ETF you're thinking about buying first. I'd love to know. And don't forget to subscribe for more friendly finance tips, and I'll see you in the next one.